Welcome to the second video of the series of videos on the CFA Level 1 course. As you know, this is the second video in the series. Today, we will continue with the corporate finance and equity part. This is video number 2. The first item in the table of content is the corporate governance. But before that, I got an email from one of the subscribers asking me to provide more examples of my claim in the last video, that this equation is central to the finance field. I will start with the famous one, which is the net present value calculation. As you can see, it is about cash flow in the first year, cash flow in the second year, cash flow in the last year, divided by 1 plus R. So R is the rate of return, and cash flow 1, cash flow 2 is also cash. So, but why the 1 and why the 1 and 2, 3, N? We'll discuss this when we come to the topic of net present value. My point here is that the cash flow divided R is the cash flow divided R in the net present value calculation. Let us see another example of bond pricing. What's the value of any bond in the market today? Depends on the coupon payment. Coupon means interest payment. The bond pays interest every certain period, like 1 month, 3 months, 6 months, or even annually. Let us assume annual payment of certain amount to the bond holder. It is called coupon in the year 1, year 2, until year end. So basically you are going to receive cash in the form of coupon, that is cash. Yield to maturity is still the rate of return. This is similar, as you can see, to the previous equation of the net present value. So basically you are going to receive cash, even the cash of the bond face value at the end of the period of the bond or the maturity period. You are going to receive the face value plus the interest due on that day. So the face value also we add it back, but we calculate its net present value raised to the power of number of years to today's bond price. Bond price means value. Coupon 1 and 2 is also cash. Yield to maturity is R. So again, bond price is also the value of the bond equal the coupon payment, the cash, and the required rate of return. Let us now take a very complicated equation, but I will not go into details because this is not the topic for today. That equation is about Black-Scholes model. Black-Scholes model. This model calculates the value of the option. What is an option? An option is a contract that gives you the right to buy or sell an asset in the future. So let us assume that we are in January and you bought an option that gives you the right to buy a share in June, that is after 6 months. What's the value of this option today? So C is a call option. What does a call option mean? It is an option to buy the share in June at a price is called strike price, K. So you are going to pay K after 6 months. So what's the value of this option today? Is basically the stock price today, S, the current stock price today, minus the strike price you are going to pay in June. So if the the price today of the stock is $10 and you have the right to buy it at $8, that means 10 minus 2 equal, 10 minus 8 equal $2. This is the value of the option. Simple idea. Forget about all this later. It is about the stock price today or at the time of exercising in June minus the exercise price that you are going to pay to buy. We said this is a call option. You are going to buy it for K, and the price in the market, current stock price, is S. So S is 10, and you are going to pay 8. That means you are making a profit of plus 2. But if it is the other way around, the stock price in the market is 8, and the strike price you are going to use is 10, that means 8 minus 10 will give negative. Makes sense, common sense. So now let us go back to our main idea. How come value equals cash, your central equation, relate to this topic? K is the option price in June. So K to the power of minus R. We know from algebra, if there is any figure raised to the power of a minus figure, we need to change the minus into positive by taking the R down to the K. So the equation will be like this. It is K divided R to the power of 2. R to the power of 2 without negative, because we now brought it down as denominator. So what does this tell us? It tells us the price we are going to pay, K, cash outflow, divide R, which is risk-free, rate of return. So again, Black and Scholes use the same formula. This is the call option, the option to buy. What about the option to sell? You have the option to sell the stock market in June. We call it put option. And this is the equation, put option. The equation says that the price you are going to receive after 6 months, the strike price, minus the value of the stock will be your profit or loss. Now, if the stock in June, the strike price, let us say $10, and the price in June is 8, you will buy it at 8 and sell it at 10, and you make a profit of 2. This is why K came first, while K here came next or to the right of the minus equation. It is opposite to the call option, because this is the right to sell. Again, this is basically the net present value, K, divide R to the power of 10. K is the cash you receive from selling put option. You are going to sell the asset. The cash you receive, divide R, rate of return, will give you the value of the put option. Let me put this and this formula together here for you so that you can make the difference. Call option, option to buy, the strike price minus, the current price minus strike price. Put option, the other way around. See, we brought this down and we brought this here. This is not our topic. Our topic is that the value of anything equal the cash you receive or expect to receive, divide the required rate of return. The return you require is not up to you to decide. It depends on the risk. And we said in the video number 1 that if the risk is high, you won't be willing to accept 2% or 3%. You want a very high interest rate of return to compensate you for shouldering this risk. This is in terms of finance terminology. But in simple terms, I did mention in video number 1 that if a building in a stable country fetch 4% and you buy it for $3 million, you will not buy it for $3 million and get 3% if you are in a country that is corrupted, that is have always riot, there is no strong legal system, there is no access to justice, the investors are not well protected, there is a lot of risk. So you will pay, let us assume, half of the $3 million to buy it. That is $1.5 million. So your rate of return of 3% will become 6%. So the higher the risk, the higher the required return. Let us go back to our main topic of corporate governance, and this is one of the definitions. There are so many definitions in this area, but among countries, each country have a specific emphasis on either the legal system or in the managerial tools that is used. It is about internal control that is instigated in the country to provide checks and balances, and also provide incentive so that the different managers can behave in a manner that is fair to everyone, either inside the company or outside the company. We have so many regulations that has been issued to regulate the behavior of managers. The first one is Cadbury report. Cadbury is the name of a lord in United Kingdom, who was the chair of the committee that has been established to prepare the report. That report actually focused on responsibility of the company's board of directors, shareholders, and auditors. It enumerates all the responsibilities and of the shareholders, of the managers, board of directors, and also the auditors. But its emphasis is mainly on shareholders, that the shareholders are the main stakeholder. Then in the United States, they issued a new act that is called Sarbanes-Oxley. Sarbanes-Oxley are two senators in the United Kingdom, in the United States, who pioneered or led this task. The shareholder theory, what does that say? It says that the main stakeholder or the main body that the company should look after is the shareholder. And that it is stated that the managers should always strive to maximize shareholders' return and shareholders' wealth. This is the theory of shareholders. It focuses on the shareholder as the sole or central body in the company that managers should serve better. But then later on, they brought in another theory. It is called stakeholder theory. What is stakeholders? Anyone who has a stake in the company is stakeholder. It is not only the shareholders. For example, there are so many groups. The shareholders, as we said, is number one, but there is creditors, that is bankers, bondholder, debenture holder, those who provide finance to the company. They have a stake in the company. They want to get paid, their principal payment, repayment of the principal, and interest payment. This is their stake in the company. Don't confuse the stake with share. Stakeholder, shareholder. So they have a stake in the company as creditor. Also, executive managers and employees. Their stake is to have a steady salary, rising salary also, and fair payment for their services. They want to have a secure job. So they have a stake in the company. It's not only the shareholders. The second group is the board of directors. Definitely, the board of directors normally set strategies and managers execute these strategies. They are accountable to the shareholders who appoint them. So the board of directors look after the interest of the shareholder. Their stake is also to have a very successful company, profitable, and achieve their remuneration and whatever they get in repayment of their role. The customer also have interest or a stake in the company. They want to receive regular services or goods at a reasonable price, not excessive price. Also suppliers, they want to have a steady business. They want to get paid on time. And finally, we have the government and the regulators. The government wants to get paid for the taxes. They don't want the manager to manipulate the financial statement so that they show less profit and less tax payment. Regulator also, they regulate the behavior of managers in the best interest of the community and the country where the company works. You can see that there is a conflict of interest among these groups, one interest directly conflict with other. Let us give some example. Let us say that if we increase the salaries of managers and employees, that will lead to lower profit. That will go against shareholders' interest. Shareholders' interest is to have huge profit as far as possible. Customer, if we lower the prices, we sell the goods and services to customers, that will lower the profit and go against the shareholders, but it is in the best interest of the customer. Conversely, if we increase prices of our goods, that will increase the profit, but it will go against customer, and so on with supplier. If we squeeze them to get lower cost to help shareholders increase their profit, this will go against the supplier who want also to gain profit. So these conflicting interests, we need to manage it in a way that, in a fair way. That is basically what is corporate governance, is to manage the different conflicting interests of these stakeholders. It is all about managing the stakeholders' conflict of interest. This is central idea in corporate governance. In fact, because of this, the corporate governance has been created. So never forget, when you read a lot about corporate governance, that what we are trying to do is to manage these conflicting interests so that everyone will be happy. This is a task is very difficult. But the central to corporate governance is the behavior of managers and employees, because their behavior directly affects creditors, shareholders, customers, supplier, government, every part, whether inside the company or outside the company. So it is the emphasis of corporate governance is the manager's behavior. Let us continue our topic and go into what is called principal-agent relationship. What is this? As we know, publicly listed companies have diverse shareholders, our owners. They are not involved on a day-to-day work of the company. They delegate or appoint an agent to run the company on their behalf. So in this case, they hire managers and board of directors. Those managers and directors are called agents, agent of the shareholder. So the shareholder is the principal. I am the principal who appointed you as agent to act on my behalf and look after my interests and manage the company in a very efficient manner. Principal, that is the shareholder, hire managers, that is the agent, to perform certain tasks in any setup, whether it is a company or at the personal level. Now, if you are leaving a country, you can appoint somebody to look after certain building, to sell them on your behalf. He is your agent. It is not only about managers and shareholders, but in this context, what is meant in the context of corporate governance, what is meant by principal agent is the relationship between shareholder as principal and manager as agent. So the agent is expected to act in the best interest of the principal. When a principal assigns a job to any agent, the general expectation by law that the agent will not behave in a way that is detrimental to the principal, whether that principal is shareholders in a company or in any setup or trading. So in this respect, manager act on behalf of the shareholders. But in doing so, sometimes managers behave in their own best interest at the detriment of the principal. For example, they might acquire another company or go huge into merger and acquisition just to build an empire and enjoy a very high salaries, perks, going into business trip, first class, just to hunt for merger and acquisition. So these action of the manager might not be in the best interest of shareholders. Sometimes even manager invest in value destroying project just to have many companies and huge building as a matter of prestige. But this will erode the value of shareholders. This is the conflict. Shareholders are principal and managers as agent, as we said, and this is called the agency theory. The agency theory, as far as I can remember, it came out in 1976 by a research paper written by Professor Jensen and Professor McNeil. Very famous paper. And it is not only about that, the agent theory. There is something called agency problem. The agency problem. That is, the managers might behave in their own interest or detrimental, in a manner detrimental to shareholders. To regulate their behavior, there is a cost to be paid. This is why they call it agency cost. You need to hire auditor, you need to have a very strong corporate governance that will hire more employees to oversee external auditor, internal auditor, checks and balance here. All these cost money. So the agency theory also state that there is an agency cost for this relationship. The only way to avoid the agency cost is for the principal himself, whether a shareholder or any setup, as I said, to run the company itself. In that way, only we can avoid the agency cost. There is other conflict of interest. It's not only about the principal and agent, shareholders and manager. I think I discussed this in the previous slide, that shareholders and managers, there is a conflict. The relationship might not go hand in hand. Also controlling a minority shareholder. If a shareholder owns 70% of the company and very few own scatter number, so that shareholder can influence the decision. Here, the corporate governance roles come in to protect the minority interest, so that the controlling interest, those shareholders who have high stake, should not pass any decision as they wish. But this is very limited role. Manager and board of director relation, as I said, the board sets the strategy and manager execute that strategy. In this way, there will be some conflict also. Shareholders versus creditor. Divergence in risk tolerance. What that means? It means that shareholder might go over high risk that might jeopardize the interest of creditor. Creditor, it is their best interest that the company keep a low risk profile and cash enough to pay their payment. There is also the risk of default. Creditor will be worried that the company may not be able to pay the principal and the interest on the loan. Also, there is a risk of excessive dividend. Managers might bypass creditor to protect their principal by paying very high dividend to shareholders. So if the company collapses, those will suffer, and the shareholder will walk away with the dividend. Also, this is an issue. There's so many other stakeholder conflict. You can find them. Customer, shareholder, as I said, product pricing. High prices goes against customer interest, but in the best interest of shareholders. Similarly with customer and suppliers. Lengthy credit to customer and company ability to pay supplier. If you provide a very lengthy credit period, for example, instead of 1 month, 6 months, 8 months, you will run out of cash. That will jeopardize the supplier payment. So there is a conflict here, and the list goes on and on. The idea is not to give all the example and keep memorizing them. The idea is that corporate governance is created to manage these conflicting interests in a manner fair to everyone who have a stake in the company. Stakeholder management. As I said, the corporate governance is to manage these stakeholder interests in a manner that is fair to everyone. How to do that? There is some legal structure. There's so many structures. One of them is legal and the other is contractual. What is contractual? Is contract between managers and board of directors, contract between shareholders and others, also contract with customers to sell them on credit, contract with creditors, contract with lenders like bankers, that is loan agreement. There will be some covenants, some restriction on the act of managers when the bank provide loan, and so forth. There is organization and infrastructure. You have to have internal audit. You have to have a compliance function within the company. This is a relatively new topic. You'll have external auditors, and there is segregation of duties. Government, how the government system is working. Okay, what mechanism we have? The first one is general meeting. We provide general meeting to the shareholders every year so that we provide them as manager with information, complete information in a transparent way. We publish financial statement so that in the general meeting can they discuss the dividend policy or any decision to be made. Also, the board of directors have their own mechanism. There is audit committee. There's so many committee within the board so that the board function in a very efficient manner and to have a supervisory body over the behavior manager. As I said, we have to report many information and should be very transparent. We shouldn't, as manager, hide any information and provide shareholder or prospective shareholders, those who intend to buy shares, with enough information to make their decision whether to invest in our company or if they are already a shareholder, whether to divest or not. So all the information should be made available. Everyone should have the right to that information, and so that the financial markets function in a much better way. Also, there should be remuneration policies that should not go against the board of the director or the shareholders' interests in a, I call it a balanced way. Contractual agreement, I just discussed this. Collateral, that is asset you give to the bank, and the bank will make a mortgage on that asset. You cannot sell it until you pay all the debt. Covenant, banks, when you borrow money from the bank will put many covenants. You should not pay dividend more than, for example, 50% of the profit achieved. Cash generation should not be less than this. There's so many restrictions on the behavior of money, the purpose of which is to protect creditor interests in the company. That is the purpose of the covenant or restriction on managers' behavior. Also, employees' laws are enacted by the country to protect their contract and their right. Yes, contractual agreement I just mentioned about supplier and customer. Well, in the line, the laws and regulation in general are all meant to protect minority interests and everyone who have stake in the company, whether that will work or not. To some degree, yes, and to some degree, or some cases, it does not work. With this, we come to the end of the second video. Please do subscribe so that you can receive the email whenever I send a new email. In the second or the third video, we will have only 3 slides on the corporate governance. The 3 slides after that, we will answer many questions in the third video and explaining how to answer the question and why the answer I provide is right. And the other choices I didn't choose, why they are wrong. This technique will help you assess the answers presented to you in a multiple format and to choose the best answer. Thank you.